So this is a topic that's near and dear to my heart because resolving a major IRS debt it can feel like you're finally escaping from something that may have been something that controlled your life for years. And I see this with my clients. Maybe your payment plan that got approved. Maybe even your offer and compromise was accepted and the balance was written off. Or perhaps the IRS has determined your account is currently not collectible. But here's the real situation. Resolving that old debt is only part of the process. You now have a new challenge, and that's protecting your future so you don't end up owing the IRS again or unnecessarily increase your chances of receiving an IRS notice or audit. I'm Bob Jablonsky. I'm a certified tax resolution specialist. I help taxpayers nationwide solve their IRS problems. And here are 7 things that you should do after resolving a serious IRS tax problem. So, number one is you should understand exactly what resolved means. And not every IRS resolution is going to eliminate your tax debt. Matter of fact, most of them don't. For example, if you have an installment agreement, the balance is still going to exist, and you could have penalties and interest continuing to accrue until you're paid in full. You have to make the required payment on time, and you have to remain current with your future tax obligations. File and pay timely. If not, you can be back to the table. If you qualify for a partial pay installment agreement, great deal. But the IRS may come back in a few years to see if you can afford a larger payment at that time. So it's not permanent. If your account is currently not collectible, collection activity may have stopped temporarily, but once again, it's not permanent, and the IRS can reconsider your financial condition in the future. As a matter of fact, they should be monitoring your returns to see if your income increases. And if you settled through an offer and compromise, the good news is, your tax debt was written off. You now owe nothing, but you generally have to file and pay your taxes on time for 5 years following acceptance. And violating those terms could cause that offer to default and potentially bring back the original liability right back on your plate. So be careful. Make sure you understand the continuing requirements of whatever your particular resolution is, and they should say it in the terms of the agreement that you sign. So number two is fix the problem that created the debt. It sometimes can be something could happen in a given year, but it's often, as I find it at least, it's rarely created by only one bad tax return. For employees, the problem may be you don't have sufficient withholding. More commonly, we see this with business owners. And in these cases, what I see happen over and over again is that a business owner falls behind on estimated tax payments where they're not setting aside enough money to pay the tax. And then they can't pay it when it's due at the end of the year when they're filing their tax return. It could also be a W-2 employee who has a part-time gig on the side, or some sort of outside income where they may need to make estimated tax payments as well. They earn a lot of interest and dividends, and maybe they had some big stock sales or crypto sales or something like that, where they have this big income on the side and they're not making estimated tax payments. So if you resolve that old balance without correcting that problem that created the issue to begin with, you're basically just cleaning up the water from a leak without repairing the leak. So review your withholding, make timely estimated tax payments, and make sure as a business owner with employees, you manage cash flow to make payroll tax payments timely. So moving on to number three, while we're on that topic of estimated tax payments, one thing you can do when you're a business owner is separate your tax money from your operating money so you don't use it. If you own a business, consider maintaining a separate account for taxes. Each time, get an estimate of on all your revenues, how much you have to pay in taxes, for example. And then each time money comes into the business on a sale, transfer the estimated tax portion into that account and don't touch it. Number four, I consider to be a fairly simple one to follow, but I see people get in trouble with it all the time. File every tax return on time, even if you cannot pay. Because one of the worst decisions taxpayers make is avoiding to file return timely because they don't have the money. Remember that filing and paying are two separate obligations. They have two separate penalties. And in many cases, filing carries a much more harsh penalty than not paying on timely. So filing on time can limit your failure to file penalties. It can preserve some resolution options for you, and it can demonstrate you are attempting to remain compliant. To give you a quick example, if you fail to pay timely, your penalty is 0.5% a month, and it takes 50 months to get to 25%, the maximum. If you don't file timely, it's 5% a month, 10 times the failure to pay penalty, and you hit that 25% maximum 5 months later. So which one does the IRS consider to be more important? Number 5, keep better records. While you cannot completely eliminate the possibility of an IRS audit, you can reduce avoidable problems by reporting all your income and maintaining documentation for your expenses and deductions. If you have a bookkeeping system, it should match the return, and you should have a bookkeeping system. Your Form W-2 and 1099 should be accounted for, and it should be reconciled to your return as well. Your business and your personal expenses should be separated if you're a business owner. Mileage, charitable contributions, and other deductions that require additional documentation should be supported. You should be in a position where you know if you're audited, you have this information. The IRS generally recommends keeping your records, your tax records, for at least 3 years. And why? Well, 3 years is the general limit to audit most returns. Some situations are going to require longer retention. The objective here is not merely avoiding an audit, it's being prepared if one occurs and acing that audit. Number 6, monitor your IRS account. Do you know you can create an IRS online account and you can look at, did you get all your returns filed timely? Does the IRS think you owe anything? Are there any issues out there? Are there opportunities, refunds that maybe are due to you that haven't been claimed? So you can see your balances, your payment history. You can pull transcripts and notices and get notice information on that account. And you can set it up just by going to irs.gov and getting your account set up. If you make estimated tax payments, you want to make sure they were credited correctly. So number 7 is conduct a tax checkup during the year. Don't wait until tax season to discover you owe another $30,000, $50,000, or $100,000. Most times when someone completes a tax return for you, a professional, that's a tax return. They're not really doing tax planning for you or forecasting of what you may or may not owe. They're preparing that tax return. So a mid-year projection, sitting down separately, it's going to give you time to change withholding, to increase estimated tax payments, or just how much money you are taking from the business. You can plan for taxes versus just being shocked by them when they happen on April 15th or whenever you file. For taxpayers who previously owed a substantial amount, that's something that's probably essential, part of staying in compliance. It's not an optional exercise. Others, it may be more optional if you've been able to control that in the past. So there may be a cost to it, but the cost of not doing it actually could be catastrophic. Well, let's sum it up. Resolving your IRS debt, it should give you a fresh start, right? But a fresh start only works if your financial and tax habits that created that original problem also change. If you owe the IRS, you have several unfiled returns, or maybe you recently resolved a substantial IRS balance and you need help in understanding how to protect your situation, contact me at 972-821-1991 or click the link in the description below and we'll set up a free strategy meeting.